All right, welcome to another Practical Wealth Minute. And what we're going to do is, hold on one second, I guess. All right, so let's talk about this. So, what I want to do is, I'm going to talk about, I just got off a fascinating call with the chief investment person for a top, sorry, I'm having a little technical difficulties. The for one of the top insurance industry companies in the industry, like $1 billion company managing billions of dollars of assets, and it just proved what we teach people of how they handle money. And see, so what I just want to talk about today for 5 or 6 minutes is two dominant approaches to money. So it's what they teach you in personal finance: accumulate net worth. I think I talked about this the other day. Retirement nest eggs. Get out of debt, pay your house off, invest for the long term. Buy term, invest the difference. Tax-free retirement. All of it's based on the stock market. And but if you and so this was so telling. When this person described what they do with the money comes in, they don't do that. They create velocity. We're going to talk about that in a second. They focus on cash flow, risk management, okay, permanent insurance strategies. That's a whole separate talk in of itself. But they don't put money at risk. They're 100% reserved. They have a big bond fund. I mean, so anybody, like, it's funny because when you have something you want to guarantee what happens, you give it to the insurance company to manage. And so one of the things is that we find at Practical Wealth with our clients is that, hey, this strategy, corporate finance, the strategies they use work great in a personal finance, and they're safer, and they produce more cash flows. Because see, the goal of the typical financial advisor, financial company, is accumulation or teach. They want assets under management, meaning that's what they brag about. But how does the firm's assets under management help you, right? Because you need cash flow. So you can't eat equity. You can't eat net worth. You need cash flow. So let's talk about that. So you got to make a decision. Which one of these do I like? See, can you because see, somebody asked me, what should I invest in? We talked about what an investment was yesterday. But once you look at that, then you've got to decide, well, do you want cash flow? Do you want capital appreciation? So if you want cash flow, that narrows down your universe. Okay. And what did I tell you? Investing is about becoming something, right? And so one of the things they talked about is they buy businesses, they buy bonds, they invest for cash flow. They just acquired two businesses, a dental business, because this company has a dental practice, so they'll buy whole businesses from other companies. This person was involved in acquisition. So can you buy or build assets is what I'm talking about. So now what happens in order to think that way, you've got to change, right? So if you want to hit the easy button and you just want to mindlessly work and max out your 401k, God bless you, okay? But you don't we talked about yesterday, you want control. See, there's four types of people, four ways to produce income. So this is from Kiyosaki's book, Cashflow Quadrants. I gotta get a better picture here. And so there's the employee, there's the self-employed. This is like 95% of the population are over here on the ES side of the quadrant. But wealth is built over here in the business system. So the tax code is on the BI side. And so I have people complain about, oh, so-and-so don't pay taxes. I was like, listen, don't hate the player, hate the game. You don't know how the game is worked. So I don't care. One of the big arguments for, you should get some type of side hustle, because once you do that, ASU, you're just sales, you're selling real estate, you're selling insurance. You actually are here in the S quadrant. That's what I realized. I wasn't really completely, but as you begin to build systems and people, you move to here, and then your goal is to move to the I quadrant where wealth happens. But if you look, I had Tom Wheelwright say, the best way, if you want to create maximum wealth, you got to create maximum efficiency. So your number one wealth transfer of wealth is taxes. So Tom Wheelwright says tax-free wealth, these people pay 40%. These people pay 60% because you got to pay, when you're an employee, your employer is paying a lion's share of your taxes. So when you become self-employed, you pay both sides. Okay. If you're making some money, you're sole props, you know what I'm talking about. And so even sole prop LLCs, because you gotta talk to your tax person. I'm not giving tax advice. And so you got to move over here. Business owners can get their average rate down to 20, and investors pay 0. So you got to ask yourself, what game do you want to play? Well, over here, you've got to learn something. Okay. And if you're not willing to learn something, then stay over here, but don't keep complaining. Okay. Because you're not willing to take control of your life. And so I know I'm stepping on some toes. And so I'm going to go over this right now. So, one of the things that you want to teach, we talk about, saving. I'm going to do another talk tomorrow, the difference between saving and investing. But savings, we teach people, you've got to save a principle. And we teach 5 principles is you've got to save 15% to 20% of your gross income. And I'm not talking about putting in money in what we call the yellow tank, which is your qualified plan. That's not saving, that's investing. And if you look at yesterday's video, it's not even really investing. But what happens is what you need safe. See, I use the acronym CLUE, control, liquidity, use, and equity. So there's a cap here because you can't lose money. Your money can't go backwards. Well, it can go backwards if you use it. You keep draining the tank. So look up our video on the private reserve strategy, or ask me for it because it's actually unlisted. And so what happens is you want to be able to save part of your money. Otherwise, money goes like this. If you don't learn how to manage your cash flow, money goes in, money goes out, money goes down the drain, right? So it's like boom, 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 out. Okay. If you don't learn to control it. And so what I want to share with you, I'm going to come back to this, is the velocity method. So how do the rich get richer? So it just proved my point. So most of the typical advice is this, right? These are ESs. So most of the world, right? So that means, people talk about the magic of compound interest, but how about the magic of compound fees? Okay. Institutions don't care about interest. Mutual funds don't earn compound interest. Okay. Mutual funds appreciate and depreciate. Okay. Somebody tell me, yeah, I like to, invest in the market because I want to earn compound interest. The miracle of compound interest, rule of 72. Newsflash. That's not how it works. And so what happens is, so you go out, get a job, get out of debt, buy a house, invest in a diversified portfolio of mutual funds, equities. I think this is the Australian or Canadian version of a 401k. This is out of the book, Who Took My Money? Okay, Robert Kiyosaki. So on the BI, so now we teach just 4. So I'm gonna add a 4th one here. There's business, there's real estate, there's paper, there's commodities. So what happens is if you make money, you build a business, buy or build a business. I don't care if it's network marketing, right? Or affiliate marketing. Folks, you got to sell something, right? You can use other people's money. You've got to select the proper entity to minimize taxation. You get to leverage on other people's time with employees or building a sales force. The tax laws favor the people on the B&I side. You can give money to charity pre-tax, right? You can use what do? You take those profits and you buy real estate, which generates cash flow, right? You get leverage, you get the entity, the tax laws favor, you get depreciation, passive losses, which leverage out your earned income. And then there's paper, right? And paper, there's private placement memorandums, PPMs, there's options, there's hedge funds, there's tax exempt. It's more in the world than mutual funds and ETFs, Okay. And then there's commodities, oil and gas, gold and silver. And so what happens is, but you have to learn some stuff to be here. Some of these things you have to be an accredited investor. So really your first goal would be to build a business and make some money. Okay. So that is my short talk for the day. All right. And Kiyosaki says the velocity of your money determines your wealth. So if you'd like to hear a little bit more about velocity, I have a report on it. Email me at kurtmay@gmail.com if I haven't put the link up to that yet, because I have to finish the landing page. So, but anyway, I wanted to publish today, and so I just a thought I had. I just watched this thing, and it just proved to me that 99%, 98% of the financial advice that you're receiving is is bad for your financial health and outright dangerous. Okay. And so you've got to learn how to play the game differently. It took me 20 years to figure this out. So I'm mad. So this is why we share this stuff. Hope this helps somebody. Have a great day.